And there's only two assets that outperform the debasement of currency. And I've talked about this ad infinitum. And that is technology stocks and crypto. And crypto is the fastest horse in the race. Why don't fuck this up is because neither of those two assets are particularly easy to own because they're volatile. They want and people hate them. People whisper in your ear all day long. They mock you on Twitter. They tell you you're stupid. You shouldn't do this. You shouldn't do this. Buy my value investing stock. You should buy the Russell 2000. You should diversify, my friend. And meanwhile, we've got probably two cycles less left to not fuck this up. Again, apologize for all the swearing, but this is actually important.
In this video, Raoul Pal delves into the intricate landscape of the evolving digital economy, emphasizing the transformative role of cryptocurrencies like Bitcoin, Ethereum, and Solana. He paints a vivid picture of this new economy, likening it to a network of interconnected nation-states, each with its unique attributes and systems. Within this digital realm, he highlights the significance of interoperable systems such as Polkadot, Quant, and Chainlink, drawing parallels to the concept of border crossing in the traditional sense, facilitating seamless interaction and integration among these digital entities. Pal then shifts focus to the broader financial markets, offering insights into the dynamics of bond yields, inflation, and economic growth. He underscores the impending challenges faced by banks, especially regional ones, as they grapple with the need to offload commercial real estate assets in response to mounting debt burdens and the impending need for quantitative easing measures. Let us now get into the video as Raoul Pal gives a more detailed breakdown of the digital and macroeconomic world. As you watch, don't forget to like, subscribe, and drop your comments.
It's really interesting when you think of it in economic terms. These are economies. This is a digital economy of crypto land that has other states within it, Bitcoin, Ethereum, Solana, whatever it may be. So that becomes very interesting. And you can think of, even within that, you've got, interoperable systems, stuff like whether it's Polkadot or Quant or a whole bunch of these things or Chainlink, interoperability. That's the travel, the border crossing from going from one of these nation states to another. We've got immigration, which is us opening wallets. We've got FDI, which is VC. We've got trade deals, which is hot money flows chasing opportunities within a country, which is the ETF. We have a monetary system. We have interest rate systems, which is the yields. We have a collateral system. You can call that Bitcoin. You could even call ETH collateral within the system because it's used within borrowing and lending. We've got asset markets, which is like NFTs. So, and there's a lot more. I've written extensively about this in Global Macro Investor and also in Real Vision Pro Macro. I've talked about this at depth too. This is a new digital economy and it's an emerging market and it's the fastest growing market we've ever seen. So that's on the crypto markets. I'm trying to think if there's anything else really to talk about in markets. Bond yields, I still think, come lower, driven by falling inflation over time and slower growth. And so I think that's fine. I'm looking down my screen, which is why I keep reaching over, see if there's anything else interesting. Banks, talk about banks, they'll eventually, the regional banks will need all of this commercial real estate being shoved off their balance sheet onto the Fed balance sheet, which will be part of the QE or whatever they call it this time around. They'll find a different terminology to stuff onto their balance sheet to pay the interest on the debts so they can roll the debt because there's far too much debt and that all has to come in 2024, 2025, which is why the whole stimulus machine starts coming and Papa Powell will do his best to appease his overlord, who's Janet Yellen. These are not independent creatures anymore. They're all trying to do the same thing, which is manage this gigantic debt burden and also the baby boomer savings complex because they can't let that go bust. To the detriment of anybody younger. Save the old people, save the financial system, save the government borrowing. Everybody else can fend for themselves. Lovely world we live in. That's all part of the everything code thesis and the exponential age.
In this discourse, Pal doesn't shy away from addressing the elephant in the room, the massive debt burden that looms over the economy. He candidly discusses the strategies employed by central banks and governments to manage this debt, highlighting the delicate balancing act of supporting the baby boomer generation's savings complex while preventing a financial collapse that could disproportionately affect the younger generations. Powell points out the stagnation due to the lack of economic recovery, setting the stage for a potential weakening of the dollar and the subsequent rise of emerging markets. He singles out India as a notable player in this arena, albeit still trailing behind powerhouses like the Nasdaq and the crypto market. Let us now hear what he has to say.
It's a singularity event for economies as well as humanity. And I think it might change economies first. I don't know what businesses even survive, what new businesses are, what the business models are. I know nothing. And that's an honest answer. So I do know we've got 1 or 2 cycles left of the everything code, because we can't avoid the everything code because nobody can pay the debts, and in which case the whole system collapses, which they won't do because the baby boomers need to retire and they're trying to support the baby boomers savings complex and the government itself. They can't raise taxes to pay for the bills because nobody's got any money, and politics are too fragile right now to raise taxes. So they just clip the coins instead, which is debasement of currency. And there's only 2 assets that outperform the debasement of currency. And I've talked about this ad infinitum. And that is technology stocks and crypto. And crypto is the fastest horse in the race. And now, why don't fuck this up is because neither of those 2 assets are particularly easy to own because they're volatile. They want and people hate them. People whisper in your ear all day long. They mock you on Twitter. They tell you you're stupid. You shouldn't do this. You shouldn't do this. Buy my value investing stock. You should buy the Russell 2000. You should diversify, my friend. And meanwhile, we've got probably 2 cycles less. 2 cycles less left to not fuck this up. Again, apologize for all the swearing, but this is actually important. I'm planning on something to get you over here, so just shut up. I'm looking after you, don't worry. Frank Anthony, Raoul, have you considered putting the bond trade back on? No, because I've now come round to the fact that everything is a suboptimal expression of the same trade. And the trade is liquidity, and the optimal expression is crypto and technology. I would rather put risk capital into that trade than the bond trade. And, you know, a lot is priced into the bond market, so I just don't think it's as attractive. You know, I just think, you know, what do I rather do? You know, make a decent, you know, rally, 30, 40% rally in the bond market and go, well, that's great. 30% rally, let's say. Unbelievably good year in bonds. Versus 5x in Solana or whatever it'll do next year. 10x. Oh, I did 10x last year. Whatever. It's just like, none of it compares. Just none of it compares. So I just don't do it. I will let you know if I think it's a good trade. Won't mean that I will do it.
Workers in Europe are hoping this year's pay round will help restore incomes eroded by higher prices, but the expected boost to their purchasing power could hamper the European Central Bank's efforts to bring inflation back to target. The ECB has singled out wages as the single biggest risk to its 1 to 1.5 year crusade against inflation. It expects salary growth across the Eurozone of 4.6% this year, far more than the 3% pace it considers consistent with inflation at its 2% target. We see a path to 3% wage growth, but it will be a bumpy road. Raymond Lydon, an economist at the Central Bank of Ireland and one of the minds behind the popular Indeed wage tracker, said in an interview, "Pay hikes increase costs for firms and boost household income, both factors that might push up prices and require the ECB to keep rates high. Unions see a combination of gradually cooling inflation, low unemployment, and fat corporate profit margins as their best and possibly last shot in this economic cycle at restoring workers' living standards." And after seeing their real wages drop by roughly 5% in 2022 to 2023, and decades in which labor has lost its leverage, wage earners are ready to fight. U.S. giants Tesla, opening a new tab, and Amazon, opening a new tab, are among companies already grappling with strikes in Europe. Unlike in the United States, there is no real-time wage data for the 20-country Eurozone. But the Indeed wage tracker, which measures salaries advertised on that website, is closely watched by the ECB as an indicator of future trends. It ticked higher in December, to 3.8% from 3.7%, although that was well below a peak of 5.2% recorded in October 2022, when inflation was at its peak. Employees at French state-owned power group EDF are demanding a 6% wage increase, or they will go on strike, while some German rail workers turned down an 11% rise spread over time because they wanted a shorter working week. Some Amazon workers in Spain staged Opens new tab walkouts during the crucial holiday season, and Tesla has faced blockades in Nordic countries aimed at making it sign a collective bargaining agreement in Sweden. At the moment, the economic conditions are conducive to strengthening the union's bargaining position, Torsten Muller, a researcher at the Trade Union Institute, said, but Lucio Baccaro, also a professor at the Max Planck Institute, said such wage militancy could backfire if it caused the ECB to keep interest rates higher to curb demand. If a wage price spiral is triggered or if the central bank fears that it is, it will intervene to cool off the economy, he said. What do you think about the interoperability of the digital world and how it relates to the present macroeconomic world? Do you find them as similar as Raoul pointed out? Let's hear your thoughts in the comment section below. Also, don't forget to like, subscribe, and turn on notifications. Thanks for watching.